This presentation is merely a brief overview of the topics covered in the chapter and should not be considered a substitute for reading the chapter. This chapter covers the two sources of money, you and other people, and takes a close look at cash, savings, credit, and debt. Ultimately, you have two sources for money, yourself or someone else. Financial management helps you decide when to use whose money and how to do so as efficiently as possible, maximizing benefit and minimizing cost. Most people use a checking account as their primary means of managing cash flows for daily living. Incomes from wages and perhaps from investments are deposited to this account and expenses are paid from it. The actual deposit of paychecks and writing of checks, however, has been made somewhat obsolete as more cash flow services are provided electronically. You have many choices when it comes to savings. You must first consider your liquidity needs, then consider your risk tolerance and the interest rate offered by the various options. Although money market mutual funds are considered low risk, we know from the recent financial difficulties some of them have encountered, they are not zero risk instruments. Although this chart shows money market mutual funds and CDs as paying more interest than savings accounts, it is sometimes possible to find a savings account that offers an interest rate that is as high or higher than some CDs and money market mutual funds. In addition, a savings account offers better liquidity than a CD, so it can pay to shop around. In finance, giving someone credit means allowing them to delay payment. Credit is used by consumers as a cash management tool or as short-term financing for consumption. Credit cards allow consumers short-term financing so that they can purchase goods and services now and pay for them later. Debt is long-term credit or the ability to delay payment over several periods. Credit is used for short-term recurring expenses, whereas debt is used to finance the purchase of long-term assets. Credit is a cash management tool used to create security and convenience, whereas debt is an asset management tool used to create wealth. Two very common uses of debt by consumers are car loans and mortgages. Your ability to get credit and the interest rate you will have to pay are heavily influenced by your credit score. In the United States, there are currently three major credit rating agencies: Experian, Equifax, and TransUnion. Each calculates your score a bit differently, but they share a common process. They assign a numerical value to 5 characteristics of your financial life and then compile a weighted average score. Scores range from 300 to 900. The higher your score, the less risky you appear to be. The 5 factors that determine your credit score are your payment history, amounts you currently owe, the length of your credit history, new credit issued to you, and the types of credit you have received. The ratings agencies give your payment history the most weight because it indicates your risk of future defaults. You are entitled to 1 free credit report from each of the 3 credit bureaus each year. Unfortunately, many people believe they must go to freecreditreport.com to get these reports. That is not the case. That site is for profit and attempts to get you to spend money for something that you do not need to pay for. You can get your free credit reports at annualcreditreport.com. You should check each of yours each year to be sure that there are no mistakes and that your identity isn't being used by someone else. These free credit reports may not contain your actual credit score, but they are important for you to review nonetheless. Consumers secure long-term loans for assets like cars and homes. A car is typically paid for over a 3 to 5 year period, while homes are usually set up with loans for 15 or 30 years. To protect themselves from default, lenders must carefully consider the creditworthiness of loan applicants, and most consider the 5 C's. Character, which assesses the borrower's attitude toward repaying debt. Capacity, which takes into account the borrower's income and expenses. Capital, which is the borrower's asset base. Collateral, which is an asset pledged in case of default. And conditions, which refers to the current and future economic conditions which will affect the borrower's ability to repay the loan. That concludes this presentation. I hope you enjoy reading the chapter.